Welcome to a short video on accounting for exploration and evaluation activities. We'll also push beyond the exploration and evaluation phase to development, extraction, and sales. There are two key issues in relation to the accounting for exploration and evaluation activities. These are 1. How to deal with the costs associated with the exploration for natural resources, and 2. How to deal with the value of the resource if you do happen to find something. According to AASB 6, for each area of interest, the expenditures incurred in the exploration for and evaluation of mineral resources shall either be A. expensed as incurred, or B. partially or fully capitalized. In essence, this means that if a company spends money exploring for oil or gas or some other type of natural resource, then it can either debit expenses or debit asset. Turning to an example. In this example, we're going to assume that all evaluation and exploration activity costs are capitalized. This company has two areas of interest, A and B. $2,000 was spent in Area A, and the entry for that would be debit exploration and evaluation asset $2,000 and credit cash $2,000. At the same time, $4,000 was spent exploring in Area B, and a similar entry is entered. Now, something is found in A, so the E&E asset is reclassified as required by paragraph 17. This reclassification switches the E&E asset into another asset, this one called asset under construction. However, in Area B nothing is found and they have stopped looking. This E&E asset would be subject to an impairment test and written off. So there is a debit impairment loss of $4,000 and credit E&E asset of $4,000. And that pretty much is the extent of AASB 6. We will continue on, but this brings into play a whole range of other standards, including AASB 102 inventory, AASB 116 property, plant and equipment, and AASB 118 revenue. If we're going to look at the development, extraction and sales stages, we'll need some additional information. First is how much resource has been found. In this case, 100 units have been found. This is important as the way in which costs are allocated to inventory extracted is based on the proportion of the resource extracted as compared to the amount found. In reality, this estimate can change, and this would be dealt with by applying AASB 108 accounting policies, changes in accounting estimates, and errors. The company also has to spend money setting up the site, and in this case spend $1,000 on infrastructure such as road links, which cannot be removed, as well as $200 on portable buildings which can be used elsewhere. These buildings have a 10-year life. The incremental cost of extraction, i.e. labour, is $2 per unit, and the units can be sold for $50 each. First, the resource found. The 100 units is not recognised. So, turning to the development entries. The asset under construction from previously is reclassified into property, plant and equipment. The $1,000 spent on infrastructure and $200 spent on the portable buildings are debited to PPE and buildings respectively. It is important to keep these separate as the way the cost of these items is allocated to inventory is different. Now, to start extraction. In this year, we'll assume 40 units are extracted. This means we've created inventory, so we debit inventory. However, until we allocate the various costs to it, we don't know how much. Cash is credited 80, which is the $2 per unit extraction cost multiplied by 40 units. PPE is credited 1200, which is the 40 units extracted divided by the 100 units found, multiplied by the $3,000 in PPE. This is comprised of the $2,000 spent on exploration and evaluation activities and the $1,000 spent on infrastructure. Lastly, $20 is credited to buildings. As they've been used for 1 year, so 1/10 of $200 is $20. This means that the cost of the 40 units of inventory extracted in the first year is $1,300. Now, to make some money, we'll assume 30 units are sold for $50 each. This is a straightforward debit cash credit revenue entry for $1,500. And then debit cost of goods sold credit inventory $975, which is the $1,300 inventory cost divided by the 40 units extracted multiplied by the 30 units sold. And that wraps up accounting for exploration. The key takeaway points are 1. AASB 6 is an historic cost standard. The fair value of the resource found has nothing to do with the financial statements. It is simply dealing with the cost of exploration. 2. AASB 6 is not a mining industry standard. It simply deals with the cost of exploration and evaluation. Once inventory is started to be produced and sold, other standards we have looked at start to kick in. 102, 116, 118. For an area of interest, you can either capitalize or expense the cost of exploration. And lastly, if you capitalize the cost of exploration, you keep it on the balance sheet if you're still looking for something in that area. If you have found something, you reclassify the E&E asset into other assets, and if you find nothing, you write the E&E asset off. I hope that helps. If you have any comments, questions, or feedback, you can either leave them here on this video or tweet me at Dr. Dave Bond.